Okay, good day audience and Assalamu alaikum. This is Mustafa Mirchawala, your FR trainer. First of all, welcome to the December 2022 webinar, revision webinar. And the objective of this webinar, is to give you confidence. I repeat, please don't turn on your cameras because it will disturb my recording. Don't turn on your cameras, all of you, please. Now listen. So as we have already recorded a lot of past papers. Even the last attempt past paper has already been recorded. The latest past paper which is available on internet has already been recorded. So the objective of this class, this revision day, is not just solving questions. The objective is to giving you confidence. Okay, because as these are last days, many students, those who didn't start the course on the right time, and those who don't start on the right time, they can't complete on the right time. So they have some confusions and they start talking with their friends and they say, negative stories to them. So first of all, just for your motivation, you can see the results. I have pasted some results, not all results. Obviously, just 80, 17, and some of students of 60s in front of you. These are the latest results. So when these students can score these marks, why can't you score 50 marks? 50, yes, 50 is everything. So when they can score such marks, why can't you? So be positive, as the good news is that the pass rate of this paper, global pass rate, is very good, like around 50, 48, 52, sometime around 50%. So in applied skills module, this pass rate is very, very good. Okay, now one thing, keep it in mind that ACCA body says this, that the reason of failure for students, those who are in applied skills module, is section C. So try to give more time on section C, right? And try to solve the questions on the exam software, Don't just solve on the Excel, even solve on the real accaglobal.com platform, right? So that you will get the same touch, And then also solve the mock exam. You should do the Kaplan mock. If there is any mock in your book, even we also send the mock. So as many mocks available to you, you should solve. Okay, because what students do, they do separate questions practice, like they do one question and then they take break, then they do second question, then they take break. No, in the examination you have to solve all questions in one go. So better you must solve the mock exam. And also, as you guys know, that we provide marking facility for ratio analysis to our registered students. So those who are registered, they must avail the marking facility. They should send the scripts to me and we'll mark them, because ratio analysis is an area where students when they solve the question and when they compare it with the kit solution, they find a big difference. Yes, because the kit solution is quite professional, but with respect to time, you will get the grip. Okay, now one thing which I came to know recently, I never said this to students, but now I should say that before exam day, sleep properly. What happened in our last exams, this 84 marks, can you see this 84 marks? This lady told me the story. In all F level papers, she scored 98 something, 98, 96, 98. That was her routine. So we were expecting same result from this lady, but this time she scored 84. You know why? She said, day before exam, I studied a lot and I couldn't sleep. And when I entered in the exam room, I was not fresh. And literally, she slept on that exam table half hour. Can you imagine that lady, that position holder lady? Just think, because she was not active. She was not active. And one more problem, the AC was, she was sitting at the place where the air condition was facing her. So that, because that was also one of the point, she couldn't perform in 90 plus. And she told me, I knew everything of the paper. The paper was very easy, but still she scored 84. But I am telling you that do follow this tip. She especially called me and tell me about this story and instruct me to tell this story to students as well. So don't forget this point. This is important. These little things matters a lot in your final result. Okay. Now, without wasting any time, we are moving. And I have gathered some new MCQs. Obviously, it's not from Kaplan Kit, because the Kaplan Kit MCQs you have already done, I'm sure. And in our classes, we also do many MCQs of Kaplan Kit. Okay. So let's move to the question. Now, one more thing. We have sent a WhatsApp group link in the chat box. All of you, please join that WhatsApp group so that we can send you some data or something after the class as well, the slides and all these things, right? Okay. So please join that WhatsApp group. Now, let's start with the question number one. Question number one. It's related to consolidation. The voice is perfect. If somebody has voice issue, that means that's the problem. It's at their end, not my end. All students can hear properly. I'm already unmute, right? Okay. Now, question number one. Pringle acquired. Pringle is P company acquired. All means 100%. All means 100% of the ordinary share capital on 1st Feb X4. As you know this, that takeover date is very important. Always highlight the takeover date. Always highlight the takeover date. Okay. Now, paying 400,000 cash. Okay. This is your COI. This is your cost of investment in the form of cash. That means it's cash consideration. It's cash consideration. Okay. And 100,000 shares in Pringle. Also, parent company issued shares. As well. So you have cash consideration. You have cash consideration of 400,000, and you have shares consideration. Wait, you have shares consideration. How many shares we have issued? 100,000. We have issued 100,000 shares. Now let me check what is the market price per share of parent company, because parent company has issued shares. Right? So parent company share price should be considered. So on the acquisition date, the market value of the share of Pringle, yes, parent company was 1.3 now. So we issued 100,000 shares as a consideration. Parent company issued 100,000 shares as a consideration, and the price per share of parent company is $1.3. So if you multiply 100,000 shares times 1.3, it will give you, I think, 130,000. So this is your total cost of investment. This is your total cost of investment, 530,000 less fair value of net assets of S company. Now be careful. You know, this is the mandatory thing, that when parent company acquires S company, S company needs to bring everything to fair value. When parent company acquires S company, parent company brings everything of S company to fair value. Remember? And for this purpose, sometimes we need to do fair value adjustment. For this purpose, we need to do sometime fair value adjustment. Let's see whether there is some fair value adjustment or not. Let's see. Okay. Now, the net assets, the net assets of single means subsidiary company was 460,000. So the net assets, the normal net assets of S company was 460,000. We need to add or less something. Now, Included in the net assets of single was land. Yes, land is an asset. Land is an asset. Land is an asset with a book value of 75 and fair value of 120. Okay. So the book value of land is 75. That means the land is already recorded at 75, but the fair value is how much? 120. So I think it's a fair value, upward fair value adjustment from 75,000 to 120,000. From 75,000 to 120,000. So it gives you a jump of how much? 45,000. Okay. And now in this way, I taught you C is equal to A minus L. Look at here. So when you increase the asset, your net assets will also go up. When you increase your assets, when you revalue asset upwards, so your net assets will also go up. So it will be added. It will be fair value adjustment. Land will be added as a 45,000 amount. Okay. Now the next thing, a contingent liability. This is a non-routine thing. Hope you remember. A contingent liability with a fair value of 15,000 had not been recognized by single at the acquisition date. Yes. Listen, let me recall you. When parent company acquires S company, and if there is a contingent liability disclosure, in the books of S company. So this is the instruction of IFRS 3 to record that contingent liability at fair value if fair value is available. So yes, parent company will be recognized this contingent liability at fair value. I repeat, wait. Look at this. This is P, this is S. And let us say there is a case when parent company acquired S company, there is a case on S company. There is a case on S company, right? But the probability of losing the case is only possible. So that's why just a contingent liability disclosure, in the books of S company. Okay. So in the individual books, it's perfect. It's perfect according to IS 37. But you know what happens in consolidated books? In consolidated books, you need to record this contingent liability at fair value. So what I call it, it's a fair value adjustment of liability. It's a fair value adjustment of liability. Now how it works, look at here. When you listen, C is equal to A minus L. When you recognize a liability, when you increase the liability, so your net assets will go down. When you increase the liability, your net assets will go down. So it will have a negative effect on net assets packet. It will have a negative effect on net assets packet. So look at here. So this is 15,000. This is 15,000 contingent liability. Now, can anybody tell me what is the final answer of this net assets packet? 460,000 plus 45,000 minus 15. 460,000 plus 45,000 minus 15. How much is this? 490. 490,000. So students, look at here. Your cost of investment is 530 and your fair value of net assets is 490,000. So automatically your goodwill should be 40,000. This is your first MCQ. So answer is C. Students, answer is C. Take your time, and no need to copy it, because further I'll provide you the slides. You just need to understand. Next, question number two. The Panda Group acquired 25%. Now, what comes in your mind? 25% is between, the holding is between 20 and 50. 20 and 50. So it looks like associate. It looks like significant influence, associate, okay. And for associate, we do equity accounting. For associate, we do equity accounting, okay. So the Panda Group acquired 25% of the ordinary shares in Antelope on 1st August 21. This date is very important. We acquired on 1st August 21 at a cost of 215,000. At a cost of 215,000. So it's your COI. This 215,000 is your COI. This 215,000 is your COI. Okay. On this date, net assets were 780,000. Right now, there is no need. In the year ended 31st December X1, Antelope made a profit. Yes, this is relevant. This is relevant. Now, what is the year end? What amount of investment in Antelope shown in the Panda's group statement of financial position, SOFP? SOFP at 31st December X1. This date is relevant. This is very basic MCQ. This is very, very basic MCQ. Now wait, hold. Look at here. What's your date? Let us say this is 1st January X1 and this is 31st of December X1. Okay. And you know, you acquired this company on 1st of August X1. So from you acquired on this date, from this date to this date, only 5 months. August, September, October, November, December. So you just need to adjust 5 months profit share. You just need to adjust 5 months profit share. You just need to adjust 5 months profit share. Now, what is the COI? What is the COI? COI is 215,000. Cost of investment is 215,000. I hope you remember the formula for carrying value of investment in associate. Carrying value of investment in associate. The formula is COI. The formula is COI at post profits of a company. Add post profits of a company multiply by your holding percentage. Add post profits of a company multiply by holding percentage. But now you have given full year profit. In the question, they have given you full year profit, but you know, only 5 months you need to take. Only 5 months profit you need to take. Only 5 months profit you need to take. Okay. So how you gonna do it? Listen, you will write COI. How much is COI? It's 215,000. Add post profit. Add post profit. Wait. So 96,000 is for the whole year. 96,000 is for the whole year. And we need for the whole year means 12 months. So we need to apportion it by 5/12. Okay. And yes, then finally we need to multiply it by our holding percentage. So our holding percentage is 25%. So how much is this? 96,000 times 5, it's 10,000. Thank you. So your final answer is 225,000. Okay. This is what we call carrying value of investment in associate. 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 Have you done it? Now, next. Be active and relax. Be active. Now, question number 3. Question number 3. See, these are a little bit dodgy questions. These are the little bit dodgy questions. These are risky questions of MCQs. Theory part. Listen. Which of the following may not be capitalized as part of cost of self-constructed property in accordance with IAS 16? With IAS 16, listen, you know, you have to capitalize all directly attributable cost. You have to capitalize all directly attributable cost, right? Or we can say without which you cannot start the project, right? But one more thing, that cost must be confirmed. That cost must be confirmed. Like, have you studied IAS 38? You remember IAS 38? Development cost. You know, when you reach to development stage, you are confirmed, you are sure that you're gonna launch that asset, you're gonna make that asset. So when you are sure, then you can capitalize. When you are sure, when there is a certainty that this thing's going to be happen, then you can capitalize. Okay. Now, pension cost of employees constructing the property. Yes, these are the employees, they are directly involved. They are directly involved in the construction. So whatever benefit, whatever salary, whatever benefit, whatever bonus you are giving, they are directly attributable cost. And yes, this should be capitalized. This should be capitalized. But what the question says, the question says not to be capitalized. The question says not to be. So we have to pick the not answer, not to be capitalized. This pension cost will be capitalized because these employees are directly involved. Now, the cost of preparing the site on which the property. Yes, this is site preparation. Remember this, this is site preparation even in our, since F3. Since F3, we teach you this word, site preparation cost must be capitalized. Because you know, there are sometimes there are sites which are not prepared. You need to dig down and you need to do some groundwork. So now, why the site preparation cost is capitalized? Because the site has been selected. The site has been selected. That means it is confirmed, right? And without this site preparation, you cannot go forward, right? Now, first read the D. Import taxes paid on the act. Yes, import duties must be capitalized because without import duties, material won't come to your site. So this should also be capitalized. Now, what else is left? The cost of selecting the site on which this selecting stage is very early stage. This selection stage is very early stage. And in this stage, you call many brokers and they give you many options. So right now you are not sure which option you are going to go. You are going to connect, right? So this cost is like research cost. This cost is like research cost, very, very early stages, no confirmation. So that's why this should be expensed out. So this should be expensed out. This should be expensed out. Okay. So be careful while solving the MCQs. You need to first pick the opposite question and then the remaining one will be your answer. This is going to be your technique, right? Yes, somebody asked research cost expense. Yes. So the answer for this question is 3. The answer for this question is C. Sorry, 3C. Yes, for option A, the logic is these employees are directly involved in construction. So whatever benefit you are giving to these employees, whatever cost you are giving to these employees, like salary, bonus, pension, anything, this should be capitalized. Now, question number 4. Question number 4 relate to IFRS 5. IFRS 5, and this is HFS, held for sale. Hope you remember the held for sale criteria. Hope you remember the held for sale criteria, right? You remember that the asset must be readily available. The asset must be readily available right now. At the date of classification, it must be readily available for sale. There must be no backlog of customer orders. And hope you remember, if you have taken the class, if that asset is to be used, if that asset is a property and this property is used principally on your location, that means you are dependent on that location. So now you need to show the substitute. You need to show the substitute to auditor as well. Otherwise, auditor won't accept. For example, hope you remember my classes. In my class, I always give this example that we have one campus, only one campus we have, right? So if we say this campus is held for sale, so that means that, in other words, it means we are going to close our institute. We are going to close our operations. Because if we don't have any other substitute of that building, that means, and we say we are going to sell this building. So in other words, it means we are going to close the business. So the substitute is must. If you have only one asset and that asset is used in your operation, so you need to show the substitute. That's the primary condition. Okay. And there is one more condition of 12 months. Hope you remember 12 months condition, 12 months condition. Hope you remember. Okay. Now let's read it. Which two we need to pick two. Which two of the following assets owned by Hartley at 31st December X5 are classified as held for sale? Number one, A, a machine which is no longer used by the company. Okay, that's fine. That's fine. The management has contacted number of potential purchaser. Yes, management is actively looking for the buyer. It's fine. And the machine is priced at current fair value. Yes, management is not asking overprice. Management is not giving ads of overprice. So this also looks fair. This also looks fair. To date, no new buyers have come forward. It's okay. It's okay. We don't need immediate buyers. We have 12 months time. Hartley is confident that the sale will be completed within 12 months. Looks like this is held for sale. Looks like it is held for sale because there is no negative thing. There is no negative thing in point number A as such. Okay, but still we need to read the all requirements. Now B, a manufacturing facility which has been actively marketed, very good, for sale since August at a price in line with other similar properties, again very good. Hartley has a backlog of uncompleted orders. Hartley has a backlog of uncompleted orders, which must be eliminated before the facility is transferred to a buyer. Okay, that means it's not immediately available for sale. This is not immediately available for sale because first we have to fulfill our duties. Now see, a property backlog means we have taken contracts from customers to do production of markers or something, and that production has not yet completed yet. A property that operates as Hartley's head office and that management expects to sell in 2006, provided that a replacement property is identified. Listen, once we have replacement property, then we'll sell this. Once we have replacement property, then we'll sell it. Management is actively searching for a replacement property. Even we don't have replacement property right now. See, we don't have replacement property right now. And if you don't have replacement property, so auditor won't believe you. Auditor won't believe you because you don't have substitute. Just think, if the customer comes right now and he says, give me this property, we can't sell because we don't have the alternative. So this is a negative point. That's why it's not held for sale. It's not held for sale. Now D, a brand name that Hartley has recognized as an intangible asset. Fine. The brand is being marketed at a price that management determined to be fair value. Fine. And the sale is expected to be completed within 12 months. Very good. Very good. Looks like D is correct. D is correct, but still we need to see E. We need to see E. A vehicle that has been damaged after a crash. Hartley expects to dispose of the vehicle within the first quarter with no proceeds. No proceeds. That means it's over. It's over. You know, HFS is an asset which we sell and we earn something, we get something. No, we won't be getting anything. It's totally write off. It's totally write off. So this is also not the answer. So which two are correct? A and D is correct. 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 Next. Question number 5. This type of question we have done. Wait, let me add a page. This type of question is normally taught in class as well, because now we are going to do impairment in 2 stages. Impairment in 2 stages. This is a question of CGU. Okay, so don't worry about it. Don't worry about it. Please have a look. Have a look. Don't turn on the camera, please. Don't turn on the camera. Now listen. Question number 5. A cash generating unit includes the following assets stated at their carrying value. Okay, so there is a goodwill, property, machines, and vehicles. Now wait. Let me write this all first. Let me write this all first. We have carrying value. Goodwill is how much? 40,000. We have property 120,000. Okay. Then we have machine 35 and we have vehicles 60,000. Vehicles 60,000, right? Now, can you tell me, can you add these four? Can you add these four, please? 255,000. Thank you. The total carrying value is 255,000. Now, the first step, the total weight carrying value of CGU is 255,000. And what is the recoverable amount? The recoverable amount of complete CGU is 184,500. Is 184,500. So yes, carrying value is higher and recoverable amount is lower. So that first of all, calculate the total impairment. First of all, calculate the total impairment. First of all, it's 70,500. Thank you, students. 70,500. Now what we have to do, go relax, very relax. Listen, we have to spread this total impairment. We have to spread this total impairment on these assets. So what are the steps? The first step is obvious impairment, then goodwill full written off, and the third step is remaining assets, remaining impairment to be apportioned on remaining assets on pro rata basis. Let me show you how to do. Now listen. Look at the screen. Please. What is written here? Vehicles include a van with a carrying amount of 10,000, which has been involved in a car crash and declared a write-off, total write-off. Out of these vehicles, there is one in vehicle means lot of vehicles. Vehicles means lot of like 5 or 6 vehicle, So out of these 5 or 6 vehicle, one vehicle is totally write-off, totally gone. So first of all, let's remove it. Let's remove that vehicle from the list. So now let me do in rounds. See, I'm writing his here impairment round one. See this. So 10,000 gone. This 10,000 gone, and one more thing, goodwill should be fully written off. So let's say bye to goodwill. So goodwill gone. This 120,000 same, this 35,000 same, and then 60 minus 10 is 50, right? Okay, so round one has been done. First of all, we did obvious impairment. Of 10,000 because one car was totally written off. And the second thing, we did goodwill. Now, how many remaining assets are left? We have 3 remaining assets. Of property, machines, and remaining vehicles. Property, machines, and remaining vehicles. Okay. So let's do the remaining impairment on these 3 on pro rata basis. Wait. How much is the remaining impairment? Can anybody tell me? 10,000 should be given to vehicle, that van, 40,000 for goodwill. So how much the remaining impairment is? The remaining impairment is 20,500. 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 Okay. Now let's do the remaining. Wait, we have property. We have other assets as well. Now wait, what requirement are they asking? You know, in MCQs, you don't need to, you never need to do anything extra. They are just asking for what? After recognition of impairment, property is measured. Only they are asking for property. So let's just do it for property. So now, can you tell me what is the total? What is the total of these 3? What is the total? 1, 2, and 3. What is the total of these 3? 120 plus 35 plus 50. 120 plus 35 plus 50. And what is the value of this property? It's 120. So in the numerator, we'll write 120. In the numerator, we'll write 120, and in the denominator, complete carrying value, multiply by the remaining impairment. Multiply by the remaining impairment. How much is this? How much is this? First, tell me the impairment amount. First, tell me the impairment amount of property. 12,000. Thank you. 12,000 is the impairment amount of property. Now, how you have to do it? Wait. Impairment round 2. Impairment round 2. And you will deduct 12,000 from here. So after everything, what amount will be left? It will be 108,000. 108,000 for property. 108,000 for property. 108,000 for property will be left. This is the answer. 108,000 for property. This is the answer. Okay. Although we can solve the complete question, if you wish, you can solve the complete question, but you won't get any extra score because you have less time in exam. Don't forget you have 20 marks ratios as well, which is time consuming. So don't spend 1 extra second on any question. Okay. So your final answer is 108,000. 108,000. Okay. Now, question number 6. It's a good one. Question number 6, a very good question. You know, since years in my class, I see this very loudly. Even I change the pitch of my voice when I teach this. You know, when you buy any debt instrument, when you purchase a debt instrument, that means you are giving loan. You are giving loan to somebody. And when you are issuing a debt instrument, that means you are taking loan, right? So these two are different things. When you are issuing a loan note, that means you are taking loan. And when you are purchasing or you are buying a loan note, that means you are giving loan to somebody. That means you are giving loan to somebody. Be careful, okay? Right? So now KL issued. So that means we are taking loan. So when we are taking loan, so it's a financial liability. It's not financial asset. It's a financial liability. Now wait, the debt instrument is classified as financial liability. The first answer is financial liability. It's not, yes, for other party, it's a financial asset, but for us, it's financial liability. Now, what is the rate on 1st January X9 at a nominal value? Nominal value is face value. Nominal value is face value. I hope you remember the face value is used for physical interest. The face value is used for calculating physical interest. Now, wait. If you want to calculate physical interest, what is the superhit formula? What is the superhit formula? Face value multiplied by coupon rate. Face value into coupon rate. Face value into coupon rate. Face value into coupon rate. What is the coupon? What is the coupon? It's 6%. So what is the physical interest? It's, I think, 240,000. Okay. 4 million times 6% is 240,000 physical interest. And physical interest is basically the cash amount which we give to the other party, physical cash. So if you're talking about statement of cash flow, operating activities, where we write interest paid. So it's 240,000 is the physical interest paid. Actual cash paid to the other parties 240,000. Don't forget. Okay. Now, which is payable annually in arrears. Annually in arrears means on the last day of every accounting period. Means on the last day of every accounting period. And yes, the last day of every accounting period also includes in that accounting period. The last day of accounting period is also part of that accounting period. The last day of that accounting period is also part of that accounting period, right? Next, the effective interest rate, now wait, the transaction cost associated with the issue 200,000. Hope you remember the issue cost. You know, issue costs are always deducted from the loan on the day one. Issue costs are always deducted. Hope you remember the final account question. Hope you remember the IAS lecture. Issue costs are not booked in P&L immediately. Issue costs are not booked in P&L immediately complete. They are first deducted from the face value, and then they are spreaded over the life of loan. Through effective interest rate. Remember? Now, the effective interest rate method measurement applies when a financial instrument is measured at amortized cost. Yes, whenever we do amortized cost accounting, so you remember we used to do EIR, effective interest rate. So this is amortized cost accounting. Now, the transaction costs are deducted. Deducted. The transaction costs are deducted. Let me give you one more identification. You know, when in the year of issue of loan, see, your face value is 4 million. Wait, 4 million. So just think, you just issued loan note and the other party gave you 4 million. You just issued loan note and the other party gave you just 4 million, and you are counting that 4 million. Now. Suddenly the door opened and your assistant came. He said, sir, we have to pay to the lawyer. We have to pay issue cost to the lawyer. And I was counting because I love cash. I was counting cash. So what I did, out of that 4 million, I took out 200,000 and I said, okay, give it to that lawyer. So now how much is left? 3,080,000 is left. 3,080,000 is left. So remember, we used to deduct issue cost. And when I teach in class, I tell you that whatever net amount comes in your hand, you start your amortized cost table with that amount. Hope you remember. Okay. So issue costs are deducted. From financial liability at the initial measurement. Now, the last, interest paid. They are not asking interest expense. See, interest expense is a different thing. Interest expense is calculated using EIR, effective interest rate. This is interest paid. Interest paid means physical interest. Interest paid reported in KLs. This is 240,000 already done. Please. So it was a financial liability because we issued. Second MCQ, effective interest rate method is amortized cost accounting. Third thing is issue cost, which is a routine thing. And interest paid means physical interest. And how we calculate physical interest? Face value into coupon rate. Now, question number 7. Not that much difficult. Only you need a brain. Basics. This is one of my favorite adjustment, that is taxation. You know, if you solve like 20 questions of final account, if you practice like 20 questions of final account, you always get the tax adjustment, remember? And tax adjustment when I teach, because right now I am teaching, so I will follow my style. When I teach, I used to make a box. For taxation, remember? Listen, this box is total tax. You know, in the income statement, we used to, after PBT, PBT, we deduct total tax, and total tax means sum of two taxes, current tax and deferred tax, current tax and deferred tax, current tax and deferred tax. Remember, you have your exam in 15 days. You have your exam in 15 days. Please don't treat me as a stranger. Don't treat me as a stranger. You have studied these things. So first of all, you always write current tax provision or current tax estimation. Current tax provision or current tax estimation. Then if there is under over, very good boy. If there is under or over provision, we add under provision and we deduct less over provision. Okay. And then finally we write deferred tax expense or income. Deferred tax expense or income. Now wait, for deferred tax you used to make one P account. For deferred tax you used to make P account and SOFP approach. Obviously SOFP approach. This is for deferred tax. This is opening deferred tax liability. This is closing deferred tax liability, and yes, the movement may be deferred tax expense or deferred tax income. That's it. The movement may be deferred tax expense or deferred tax income. Okay. Now a very little bit of taxation knowledge. Cotton company has taxable profits in the year ended. This is your current year of 430,000. Remember, taxable profits are the profits on which tax department charges tax. Taxable profits are the profits on which tax department charges the tax. Now wait, and this is used for calculating current tax. This is always used for calculating current tax. Now wait, what is the tax rate? Tax rate is 30%. Tax rate is 30%. Okay. So this first thing I'm calculating this first thing. So this first thing will be 430,000 is the taxable profit times 30%. Normally in your books, in your exam kits, this first line is ready-made. This first line is always ready-made. Okay. So, but in this question, you have to calculate the current tax estimation, and the current tax estimation is calculated, and the current tax estimation is calculated using taxable profits. Hope if you have remember my lectures, I have given in my first class of deferred tax. I teach this. I teach in this way. And also those who have studied F6, those who have studied taxation paper, they better know this. So this first line is 129,000. This first line is 129,000. This is your current tax estimation. This is your current tax estimation. Now, and the taxable temporary difference is 700,000. See, you have a taxable TD. Taxable, it's not deferred tax liability, it's taxable TD. So when you multiply, open your ears. When you multiply taxable TD with tax rate, you get deferred tax liability. When you multiply taxable TD with tax rate, you get deferred tax liability. Remember? So now, prior to accounting for the current year's income, and deferred tax, the trial balance at 30 shows a credit balance of the income tax, that is current tax. Now tell me, hope you have done the final accounts. So if current tax balance on the credit side, it's your income, it's over provision. And if the current tax balance on the debit side, it's under provision. So in this question, tell me it's over provision. 2,000 is the over provision. 2,000 is the over provision. So definitely it's your income. It will be deducted. And now deferred tax provision of, see, in the trial balance already deferred tax liability. Deferred tax provision means deferred tax liability. Deferred tax provision means deferred tax liability. And hope my beautiful students, you know this, that in the trial balance always opening balance of deferred tax is given. In the trial balance always opening balance of deferred tax is given. Okay. So opening deferred tax liability is how much? 230,000. And for this closing, your taxable TDs are 700,000. 700,000 is your taxable TDs. Multiply by the tax rate. 700,000 is your taxable TDs. Multiply by the tax rate. Okay. When taxable TDs are multiplied by the tax rate, you get deferred tax liability. And as it is a liability, it will come here. Okay. Listen, as this is a liability, it will come here. And what if it is an asset? If this is an asset, it comes here. if it's a deferred tax asset, it comes here. Okay. Now there is a decrease. There is a decrease of 20,000. So this is your deferred tax income. This is your deferred tax income, or we call it deferred tax credit, and it is also deducted from here. It is also deducted from here. So can anybody tell me what is the total amount? Your total tax expense is 107,000. Your total tax expense is 107,000. Your total tax expense is 107,000, please. It's done. Okay. Now next question number 8. Question number 8, not difficult, very routine. It is done. It is taught in class. You know, for IS 37, if you want to book provision, the first and the most important condition is present obligation, right? As a result of past event, right now you are obliged to deliver something, right? And hope you done restructuring provision. Hope you have done restructuring provision. Listen, for restructuring provision, there is one very important condition, the formal plan. And one more point which I always teach with lot of energy, and that is that you have created valid expectation in the hearts of others, in the hearts of the people, those who are going to be affected, right? Valid expectation normally goes because through announcement. Valid expectation is done through announcement or your act. So valid expectation is equally important. That constructive obligation is equally important in restructuring provision. Now open your eyes and read it. Your year end is 31st December. Your year end is 31st December. The Board of Diamond made a formal decision to shut a division of the company on 1st December X3. The decision was announced to the workforce on 6th of January X4. That means at the year end of 31st December X3, there was no valid expectation. There was no announcement on 31st December X3. There was no announcement on 31st December X3. That means no valid expectation in the hearts of the people, those who are going to be affected. So there is no present obligation. Now, the company year end is 31st December and the financial statements are expected to be issued in March. The board wishes to make a provision for the direct cost of the closure. No. We can't. Because there is no present obligation. Now, one of the Emerald Geographical Division is expected to make a loss in the coming year. Remember my lectures? I used to say this, that you can't book future loss provision now. Future operating losses cannot be booked now. Why? There is no present obligation. Why? Because there is a possibility we can close our business before that loss. So that means there is a possibility of U-turn. There is a possibility of U-turn in that provision. So again, no for this. Answer is D. In point A, listen. In point A, students, look at here, that they have just taken their own decision. But they have not announced before the year end. You know, nothing up. there are two types of obligation. One is legal and one is constructive. In point number one, there was nothing like legal obligation. There was no legal requirement of this. Okay, so it's our wish and we decided. It was our wish and we decided to close down. So first of all, we need to communicate the other parties. Then the day we'll communicate the other party, on the same day the present obligation will be created. So see, we communicated on which day? We communicated on which day? We communicated on 6th January. We communicated on 6th of January X4. We communicated on 6th of January X4. Now, question number 9. Question number 9 is IS 10. Question number 9 is IS 10, and I would say it's from famous examples. These are the famous examples. You know, IS 10 deals with adjusting and non-adjusting events, and these events are after the year end but before sign off. These events are after year end and before sign off. Okay, so the first of all, the discovery of fraud at the reporting date. The discovery of fraud at the reporting date. Yes, fraud discovered, and yes, this fraud was existed at reporting date. So yes, there is a condition. And you know, fraud is always done in hidden way. Nobody does fraud openly, right? So yes, the fraud was there at the year end. So we have the evidence, so it's adjusting. Now, a major business combination. Listen, takeovers, mergers after the year end, there is no evidence at the year end, so it's non-adjusting. An announcement of a change of tax rate after the reporting date. See, after the year end, you know, when I teach this IS, I use the word suddenly. When things happen suddenly after the year end, it's non-adjusting. A flood, obviously flood, earthquakes, these all come suddenly. So there is no evidence at the year end, so it's again non-adjusting. It's again non-adjusting event. Now this MCQ is related to your reading area. You know, I always recommend in the class to read the book. Lot of time I say, and especially I say for this framework and IS IFRS history of IS IFRS and framework. Even teachers teach this in F3 level as well. Which of the following statement is true or false? Due process in issuing new IFRS involves IFRS always. See, the word always is very dangerous. Always means a dangerous thing. They are saying that it will always happen. If he writes maybe, then the answer is different. Involve the issue of discussion paper and an exposure draft. Listen, whenever we issue, look at here, a new IFRS. So why International Accounting Standard Board issues a new IFRS? Because they get a complaint. Like, hope you remember, right now we have IFRS 15. The old version of IFRS 15 was IS 18 and IS 11. So they cancelled out IS 18 and IS 11, and now they made a new standard of IFRS 15, right? Okay. So IFRS 15, look at here. IFRS, students, IFRS 15 replaced IS 18 and IS 11. So how they launched the new standard? They first of all, they take the feedback of the whole world. That what was the problem in old standard. Then first of all, they launched discussion paper. And then they launched exposure draft. Exposure draft is one step away from the final standard. And then the people comment on exposure draft, and then they launch the final IS. So yes, exposure draft is the mandatory step. Exposure draft is the mandatory step, but sometimes they skip this discussion paper. They skip this discussion paper step when they are running short of time. When they are running short of time and when they see that this step is not necessary. So yes, discussion paper step can be skipped, but right now they have written always. Right now they have written always, so that's why this is wrong. Now, interpretations deal with, there is one committee. Let me write the name: IFRS Interpretation Committee. IFRS Interpretation Committee. Always remember, even you can read, there are two objectives. There are two objectives of IFRS Interpretation Committee. The first, in this world, there are some accounting standards, they have dual meanings. There are some accounting standards which have dual meaning. There are some lines of accounting standard, they have dual meanings, right? So standard board says that when there are dual meanings, so company, the accountant will do corruption. Accountant will pick that meaning. Accountant will pick that meaning which is beneficial for the company. So again, just like in the religion, you have seen many sects. In the religion, there are many sects, same as the many sects. Now here in the accounting world, there will be many sects. So what standard board has said that we'll launch the standard and we'll also interpret them. So the first objective of interpretation committee is to give guidance for dual meaning standards. And the second objective of interpretation committee, look at here, the second objective of interpretation committee is look at here. The second objective of interpretation committee is to correct the mistakes, If there is some small mistakes in the existing standard, they immediately launch the interpretation to correct it. Okay, so that these are the two objectives. Now see, interpretation deal with emerging issues not covered in IFRS. Yes, if the new accounting standard missed something or something new came in the world, very short thing, so overnight they launch interpretation. This is the correct. This is one of the objective of interpretation. There are two objectives. Out of these two objectives, one objective is this. Out of the two objectives, one objective is this. Then new IFRS are developed by IASB. See, once again, see the word alone. No, IASB talks with national standard setters. IASB take the feedback of the whole world. IASB takes the feedback of the whole world and they launch standard. So again, this is not appropriate. Only 2 is correct and answer is C. Answer is C. They are saying developed. See the word developed. The final thing, yes, IASB does, but the development of standard, they take help for national standard setters. They take feedback and everything. Yes, this is a dodgy question. I can agree. I agree. Now, question number 11. Question number 11 is 1 minute question. If you remember IFRS 16, otherwise it will take your half an hour. If you remember the dates and if you know what to do next, how much already done and what to do next. Listen, at 31st October 2016, Jameson has a total lease liability. See the date. This is the year end. Let us say this is your accounting period end. 31st October 16 is your accounting period end. Jameson has a total lease liability outstanding of 45,000. The lease term requires payment in arrears. Arrears means every year end of 5,000 every 31st October, and the interest rate is 4%. Now just use your brain. Wait. This liability they have given you 45,000 liability on 31st October 16. That means this year payment has already been done. This year 31st October 16 payment has already been done, and after doing this payment, this is your liability. Now you just need to account the next year liability. You just need to account for the next year payment only. I repeat, see, this liability is as at 31st October 16. So that means the 31st October 16 payment has already been done, because the liability is always as at. The liability is always as at. Okay. Now, every year they pay. So yes, very good. Some students are giving correct answer. Some students are giving correct answer. Very good. Now, every year after each year end, they pay 5,000. Now look at here. Look at here. Let me do it for you. You remember these columns? See this. Date, rentals, finance charge, decrease in obligation, and finally balance obligation. Okay. So this is 31st October 16, and your balance was C. At 31st October 16, your balance was 45,000. At 31st October 16, the balance was 45,000. Just think, one year work has already been done. 1 year work has already been done. Now what will happen on 31st October 17? How much rental we are going to pay? How much rental we are going to pay? 5,000. 5,000 is the rental. Now for the whole year, what is the outstanding amount of liability? It's 45,000. The outstanding amount of liability is 45,000. Now you tell me, 45,000 times 4%. 45,000 times 4% is 1,800. Okay. So as we are paying the rental of 5,000, out of this 5,000, how much is the interest? 1,800. So 3,200 is your principal amount. Now, what is, look at here, what is your total liability? 45,000. Out of this 45,000, 3,200 will be less. So 45,000 minus 3,200, how much? It's 41,800. It's 41,800. Okay. Now let me tell you the complete lecture. This is your total liability, and out of this total liability, this is current. Hope you remember my lectures. This is current, and this part is non-current. Okay. This part is non-current because the current liability is the liability which is going to be settled within next 12 months. Okay. So within next 12 months, how much is the decrease? 3,200. So many students gave the correct answer for this. Many students gave the correct answer for this. Yes, this was cash box. Now next. Again, you have cash marks. Question number 12. Harrison acquires the following financial assets. Financial assets. Use your brain of financial asset. Recall the financial asset lectures. Remember, in the financial asset section, you have an equity market, you have debt market. You can invest in equity market as well as debt market. In equity market, you have two categories: fair value through PNL and fair value through OCI. Fair value through PNL and fair value through OCI. In debt market, you have three categories: amortized cost, fair value through OCI, and fair value through PNL. I hope you remember. Okay. So everything is normal. Only one new word they have used. Only one new word they have used. Indicate how it should be. An investment in equity shares. So if you invest in equity markets, you have two options. If you invest in equity markets, you have two options: fair value through PNL and fair value through OCI. Remember, of an unrelated company, you have invested in an unrelated company, right? So normally when you know the company, so you normally when you know the company, so you sometime do trade, and they have not given any indication of trade. They have not given any indication of trade, so automatically fair value through OCI will be there. They have not given any indication of trade, so automatically fair value through OCI. There should be no amortized cost, right? In equity market, there is no amortized cost. Now, an investment in bonds. Bonds means loan notes. Bonds means now debt market. Now debt market. Issued by a listed company, Harrison intends to hold these to maturity. Yes, amortized cost. Remember, in amortized cost, there are two. The business model is long term. When you invest in loan notes for long term, when you invest in loan notes for long term, when you invest in loan notes for long term, when you invest in loan notes for long term, so it's amortized cost. The business model says it's amortized cost. Now, an interest rate swap, it's now, let me use, it's a derivative. Interest rate swap. Now this is a different name for most of you. Those who have studied F9, they know this. Interest rate swap is like, we call it like gambling. It's like when you call it in Hindi language, shart lagana. It's like, I repeat, it's like derivative. It's like a gamble thing. And you know, all gamble things are short term, and they always go in fair value through P&L. All gamble things are short term. They go in fair value through P&L. They go in fair value through P&L. Okay, gambling things are always go. Derivative always goes in fair value through P&L. Then, an investment in 8% loan note that Harrison holds in a business model to collect cash flows and sell. Yes, this is a mixed model. Hope you remember this new category. When you invest in loan note, you have one business model of long term. You have one business model of long term that you will stay till end. That is amortized cost. And you have one business model of short term. Remember, that is fair value through P&L. And now there is a mixed category as well, that yes, you hold it for long term, but if you need cash sometimes, so you can sell. Somebody is asking point number 1. Unrelated company means not related to our group. Okay, so this word is not important. The importance is they have not used the word short-term trading. That's why we booked in fair value through OCI. Okay. $13 again, cash marks. 13 is EPS. 13 is EPS. 13 is EPS. Listen, you know, in EPS, whenever there is a bonus issue, first of all, very basic thing I'm telling you, if it is a bonus issue, students, look at here. If there is a bonus issue during the year, we always adjust bonus shares from the beginning of the year. Number 1. Number 2, bonus shares are also adjusted in the last year restated EPS. For comparative purpose, we adjust the bonus shares in restated EPS as well. Remember? So now let's do it. Let's do it with the same spirit. AM made a profit after tax of 15 million. This is your for the year ended 30th September 14. At the start of the year, it had 15 million. Yes, this is actual number of shares. This is not share capital. This is number of shares. This is pure number of shares. It's not share capital. Okay. Examiner has written in the examiner report that people get confused between number of shares and share capital. So be very careful. These are directly number of shares. So it's easy. With a nominal value, this is not needed. This nominal face value is not needed right now. Leave it. On 1st April 14, that means on the mid of the year, like it's like mid of the year, right? Mid of the year, company made a bonus issue of 1 for 10. 1 for 10 means 10%. 1 for 10 means 10%. In the year ended 30th September, this is the last year. Company made a profit of this, and these were the shares. These were the shares. Now, wait. This is 2000 x4. This is 2000 x3. Now, wait. If I write EPS here, what is my profit? 15 million. My profit is 15 million. And what's my number of shares are? Number of shares are 15 million equity shares. 15 million, that is 15,000 shares plus the bonus shares. Plus the bonus shares. You know, bonus shares are always adjusted from the beginning of the year. So it's a 10% bonus issue. It's a 10% bonus issue. So 15,000 plus 10% is 1,500. Can anybody tell me this year EPS? Can anybody tell me this year EPS? Yes, you can do it through bonus fraction as well. It's same thing. Bonus fraction will be 11 upon 10. Those who want to do through BF, it's 11 upon 10. 10% bonus fraction is 11 upon 10. That's also right. That's also right. No issue. Tell me how much is the EPS for 2004? .909. Okay, and just calculate it for last year as well. If we calculated the restated EPS, last year the profit was 5,005,000. Number of shares was same, 15,000 plus 1,500. Can anybody tell me what is the last year EPS? 0.826. 0.8. What is the last year EPS? How much is the last year? I think they have not asked the, it's just they have asked for 2014, but I have calculated it. No need of 2003. They have just asked for 14. This is the answer. That's it. This is the answer. 0.909 is 90.9 cents. I want to give you answer for one question. Some students, no 6 upon 12. Somebody is doing a big mistake. Please, 6 upon 12. We only do apportionment. We only do apportionment for that full market price issue. Full market price issue is taken, just included from the date the issue has been done. Bonus issues are always adjusted from the beginning of the year. Bonus issues are always adjusted from the beginning of the year, and this question was not related to multiple issues. This question was not related to multiple issues. I want to give answer of one question. See this, look at here, this part A. This part A. Although it is correct, when we do final account, we say this openly to our students that until and unless examiner use the word election, examiner use the word election. Remember, if you have a word of election for fair value through OCI, then you go for fair value through OCI. If it is nothing is written, then it's a default category. It's a default category, fair value through P&L. It's okay. But you know, there are some MCQs are confusing. Even those who made the MCQ, they sometime keeps some blur areas in MCQs. It happens in F2, F3, all papers. Some MCQs are like 0.1% of the paper, like 1% of the paper, it's blur. So investment in equity shares, if only written investment in equity shares, yes, and nothing is written, it's fair value through P&L. of an unrelated company. Now, this unrelated company is a blur word. It's a gray word. Unrelated company means we haven't done any research and we just want to keep it for long term. We need to keep it for long term. So this indicates fair value through OCI, right? Okay. But if you get this type of question in a descriptive part like section C, if you get this type of question in section C is a different area in which you can write, you can type. So you can write your assumption as well. You can write your assumption as well, and examiner equally gives weightage on your assumption that what you are assuming. And if you have written the note, okay? So no need to confuse. Now, question number 14, again a dodgy one. Question number 14, again a dodgy one. You know, in IS 8, there are three things. Changes in accounting policies. Changes in accounting policies are adjusted retrospectively. Changes in accounting estimates, judgments. Estimate is about information, judgments, assumptions are adjusted prospectively. And prior period errors, material prior period errors are adjusted retrospectively. These are the basic concept, okay? Changes in accounting policies are adjusted retrospectively. Accounting estimates, change in accounting estimates, judgments, assumptions are adjusted prospectively, and prior period errors are adjusted retrospectively. Now, read the lines. There is some dodge. Number one, a change in the assumption. See the word, what they are using the word. They are saying the change in the assumption. Assumption means judgments. Judgments means estimates. So this word indicate estimates. This word says the change in information. Some new information came to us. Used to measure the cost of inventory from first in first out to weighted average. This is prospectively. This is change in accounting estimate. But normally, yes, in our classes we give example that first in first out and weighted average are accounting policies. First in first out is one of the policy. But right now, see the words. See the word they have picked. They have picked the word assumptions. Assumptions. So assumption means there is some new information. There is some new information. We have to do some judgment. So this new information just arrived today. So this is change in accounting estimate because of the word assumption. Because of the word assumption, yes, it's a dodge. It's a total dodge. A change to measure investment property at fair value rather than cost. Yes, this is retrospective. Cost model and fair value model, these are your policies. These are your policies. Cost model and revaluation model, these are your policies. And yes, changes in accounting policies are adjusted retrospectively. In this part, there is nothing is written about it. Nothing is written about assumptions and all. But in the first part, assumption, the word assumption, if you read the book, this clearly shows it's about estimates. And the last, the correction of a material error 2 years. See, prior period errors are also adjusted retrospectively. Prior period errors are also adjusted retrospectively. Prior period errors are also adjusted retrospectively. Okay, now question number 15, a short one. Question number 15, a short one. Listen. True and false. Goodwill should be amortized over its useful life. Never. There is no finite life of goodwill. Goodwill can be up. Never. Goodwill can be revalued upward. No. If you have started revaluation of goodwill, it will become internally generated. The extra new goodwill will become internally generated, which is not allowed. Goodwill should be tested for impairment at least annually. Yes, at least annually we test. At least annually we test. Yes, for goodwill. Then goodwill should be carried at its cost indefinitely. No. We have in future we have to do impairment, and when we deduct impairment, so a new number comes. A bargain purchase is recognized. Yes, the bargain purchase, gain on bargain purchase Gain on bargain purchase is your income immediately. Yes. Gain on bargain purchase is your income. Gain on bargain purchase is your income. Done. This was easy. This was not difficult. Please. Option D. Yes, I can repeat. They are saying goodwill should be carried at its cost indefinitely. No, no, no. Not cost. This cost will be revised because of future impairments. Because of future impairment, you can't keep at cost always. Now, this is your IAS 21. Little knowledge is needed now. IAS 21 about monetary and non-monetary. About monetary and non-monetary. Remember foreign exchange. Remember foreign exchange transactions. Please don't sleep now. In November 2015, look at here. In November 2015, Brooks purchased on credit. Keep highlight the date. Highlight the date, that is November 2015. Highlight this date and also highlight that this is a credit event. Okay. Now, for yen, 900 yen. 900 yen. First thing. Wait. What is the exchange rate on that date? This is the exchange rate. Wait. This is the exchange rate. Wait. So 110Y is equal to $1. 110Y, 110 yens is equal to $1. So we have to shift from a bigger number to smaller number. See, we have to shift from yen to dollars. So 110 yen is equal to $1. So bigger number to smaller number. So now the new answer will always be smaller. New answer. This is the identification. New answer will always, after shifting, the answer will be smaller one. Okay. So we need to divide. Wait. November, it's 900,000 divided by 110. How much is this? 8181.8. 8181.8. Now wait. Just think, we have to make one entry. Purchases debit or inventory debit. Purchases debit 8181.8 and your payable credit 8181.8. Okay. 8181.8. Now don't run fast. Wait. I always teach this question in my class because now you are going to do partial payment. You will do half payment now, half payment next year. Half payment now, half payment next year. Hope you remember. And do remember this payable. This payable is your, listen students, this payable is your monetary item. This payable is your monetary item because you have to deliver in cash. Okay. So all exchange gain or loss related to monetary item. All exchange gain or loss related to monetary item goes in P&L. Okay. Now wait. Let me make a timeline for you. See this. This is November 2015. And now you made half payment in December. Mid-December means 15 December. Wait. On 15th of December 2015, you paid half payment. And the remaining payment you paid in January. And we are not concerned about the January. That means the remaining amount is unpaid. The remaining amount is unpaid. The remaining 50% is unpaid at the year end. Remaining 50% is unpaid. So 50% and 50%. Now wait. One excellent thing I want to share. What is the what is the total amount of liability on day one is 8181. The total amount of liability on the day one is 8181, and we know this thing that this will be settled 50-50. We know this thing that this will be settled 50-50. So now what we do? Just 8181.8 divided by 2. Do divide by 2, please. Do divide by 2. So 4090.9. This technique I follow in my classes as well. So your half liability is 4090. Your half liability, that means wait, this is dollars, this is 450,000 yens. That means on November 2015, 450,000 yens was equivalent to 4090.9, and that means the half liability was initially booked as at 4090.9. The half liability was initially booked at 4090.9, and don't forget it's your liability. Don't forget it's your liability. This is a very big MCQ. It will consume your 6-7 minutes. Now, look at here. Read the question. Now, when you go to pay, Brooks paid half of the outstanding balance in the mid-December when the exchange rate was 112. See, now, at the time of payment of this 450,000 yen, the rate was 112. So how much dollars we had to pay? We had to pay 4017.8. See, this is the amount of dollar we have to pay. And how much initially we booked? How much initially we booked for 50%? How much initially we booked for 50%? Use your brain. Initially we booked for 4090. Initially we were expecting that we had to pay 4090.9, but finally we just had to pay 4017. So it's a benefit. You are paying less, so it's a benefit. Benefits means gain. So how much gain on this first transaction? It's 73.1. Is 73.1. Somebody's asking how to calculate 450. 450 means half of 900. 450,000 yens is half of 900,000. So first gain I have calculated. That is 73.9. First gain I have calculated, that is 73.9. Now the second thing, the remaining 450,000 yen, is unpaid at the year end. The remaining 450,000 yen is unpaid at the year end, and you know the rules that unpaid monetary liabilities must be reclassified using the new exchange rate, must be retranslated using the new exchange rate. Okay, so what is the new exchange rate at the year end? It is 114. Wait, no, wait, it is 113. The exchange rate at 31st December x 2015 is 113. You can see. So now let's calculate, divide by 113. What is the value of your liability? What is the value of 3982? 3982.3. So wait. How much you were expecting? You were expecting the other 50% at this amount. The other 50% you were expecting also at this amount. The other 50% you were expecting on this amount, 4090.9. 4090.9, but you know, things turned in your favor and your liability just came down to 3982.3. Your liability just came down to 3982.3. So again, you get the benefit. Again, you got the exchange gain. Again, you got the exchange gain at the year end. How much? Yes, 4090.9 minus 3982.3. 4090.9 minus 3982.3 is, it's 181. How much? 181. It's 1. It's 18. No. What is the number? Tell me. What is the number? It's 108.6. Yes, sorry. So this is one more gain. So there are two gains. There are two gains, student. First gain and second gain. Can you plus these two? Can you connect these two? Can you add these two? What is the total gain? The total gain is how much? 182. 182 is your total exchange gain. The question has not yet finished. There is one more part. The total exchange gain is 182. 182 or 181.7, whatever you say. 182 or 181.7, whatever you say, it's your wish. Now have a look. Still some part of this question is left. Still some part of this question is left. Just look at the question, please. Now, one which you have to pick two answers, okay? So one answer I have already picked, and that is an exchange gain of 182 is recognized. This C part is correct. This C part is correct. D is wrong. D is wrong. Your payable is 3982 at the year end. Your payable is 3982 at the year end. This is wrong. D is wrong. D is pure wrong. A cash outflow of 4091. No. How much cash we paid? We paid 4017. We paid this cash. We paid this cash. Use your brain. We paid 4017. We paid 4017. So E is also wrong. So only C is correct till now. Only C is correct till now. Now, the dodgy part. You know, this question was a mixture of monetary and non-monetary. Please, if you understand this question, this is a big win. This is a big win for you. I'm telling you. This question was a mixture of monetary and non-monetary. Monetary item was payable and non-monetary item was inventory. Inventory is non-monetary thing. Yes, because when you buy inventory, there is no contractual obligation to receive cash. We never know when we are going to sell your inventory. So inventory is non-monetary item, and write one line. Write one line in your book if you want to. Non-monetary items are recorded at their historic rate. Non-monetary items are recorded at their historic rate. So what was the historic rate? Historic rate was 110. Historic rate was 110. So yes, this was the value of inventory. This was the 8181.8. 8181.8 was the final value of purchase inventory, was the final value of total purchase inventory, because it's a non-monetary item. It's a non-monetary item, and non-monetary item are recorded at historic rate. This is the first step. Okay, now see how much it is sold. Wait, read the question. At this date, 2/3 of the purchase inventory remained in stock. With us, how much is in the stock? Still 2/3. And how much is sold? How much is sold? 1/3. 1/3 is sold and 2/3 is still with us. So see the breakup. See the breakup. 1/3 is sold. Can you calculate 8181.8 into 1/3? 8181.8 into 1/3. Can you 2727.2? So 2727.2 is sold, so it will be part of cost of sales. Whatever inventory is sold, use your basics principle. One thing I forgot to tell you. You know that position holder student also told me that examiner is also testing some areas of F3. Examiner is also testing some areas of F3. So those who worked hard in F3, they will earn good marks now. The base is very important. The basic is always very important. Listen. So and you know, there is a chapter in F3. There is a chapter in F3 about discounts. There is a chapter in F3 about discount allowed and discount received. And for discount allowed, say there are some new IFRS 15 rules since last 5 to 6 years. Okay, so they may test that thing as well. So 8181.8, 2/3 of the inventory with us. How much is 2/3? How much is 2/3? 54.5. Now, year-end inventory. This should be your year-end inventory. So if examiner asks you about the year-end inventory, if examiner asks you about year-end inventory, this is the answer. This is the answer. And if examiner asks you about the cost of sale, this is the answer. Okay, see the numbers. Year-end inventory and cost of sales both are in front of you. Year-end inventory and cost of sales both are in front of you. Have a look, please. Now please check. Inventory at 30. No, this is not your year-end inventory. Year-end inventory figure was different, 5454. But yes, cost of sales is 2727. This is perfect. So your final answers are B and C. Your final answers are B and C. Yes, it was a detailed question and it is very important for your revision as well. This is very important for your revision. Now start hitting. Now start hitting sixes. This is bonus. Bonus. Come on, enjoy. You worked hard. Now eat chocolates. Start. These are sweets for you. Come on, 17. 17 is a chocolate or sweet, whatever you want to say, you can say. 17, 18 are both chocolates. And if you can't do 17, please resign. Please resign from whole ACCA, not just F7. Which two of the following statements are correct? An asset is impaired if the carrying amount of asset is less than. No, if the see, for example, the carrying value is 1000 and recoverable amount is 800. Yes, now there is an impairment. Now there is an impairment. Whenever carrying value is higher and recoverable amount is lower than impairment. So A is not the answer. B, an impairment loss is calculated as the excess of carrying amount over the. Yes, this looks correct. Now, the recoverable amount is the higher of value in use. Yes, the recoverable amount is the biggest benefit. And when I say this in Hindi or Urdu, bade se bada fayda. Remember, bade se bada fayda. So recoverable amount is higher of value in use and fair value less cost to sell. The recoverable amount is lower. No, the value in use is the carrying amount of an asset. No, value in use are just the present value of future cash flows. Value in use are just the present value of future cash flows. That's it. This was not tough. This was easy. Now, question number 18. Question number 18 is pure operating lease. See, operating lease. Question number 18 is pure operating lease. Listen, you know, nowadays all 90% leases are finance lease except two. There are two exceptions. If the lease term is less than 12 months, then it's operating lease. Or if the lease belongs to low value asset, and still you have option. You have option that you go for operating lease with low value asset. Okay. Now, Hart enters into a 3-year lease. Apparently 3 years is more than 1 year. So it looks like a finance lease. But wait. For a machine for 600 per annum in advance, this is your normal rental. Wait. Yes. Heart also pays a non-refundable deposit of 300. So it's a one-off payment for 3 years. One-off payment for 3 years. The machine is low value and simplified accounting is applied. Simplified accounting means operating lease. Simplified accounting is operating lease. Okay. And in operating lease, we never book ROU. We never book right of use, lease obligation, nothing. We just book rentals in the P&L. So now wait, look at here. 1, 2, and 3. These are the 3 years. First year it's 600 rental, second year 600, and third year 600. It's okay. Every year rental will go in P&L in the same year. Every year rental will go in P&L in the same year. But what? Wait. You just paid 300. You just paid 300 initially for 3 years. You just paid 300 initially for 3 years. Now use your common sense. You know the matching principle? You know the matching principle, dear students? Let me give you one example. Sometimes when you buy, listen, when you acquire some premises on lease, like a shop, and that shop is on very high location, excellent location, lot of petrol pumps and a lot of good things near your shop, so you will get more customers. So sometime, you know what, one word, the landlord charges the location premium. Landlord charges the one-off location premium. So what you should do, as you have paid this location premium for 3 years, you are going to take benefit for 3 years, so it should be spread over the life. It should be spread over the life. So this 300 for 3 years. So how much? 300 divided by 300 here, 100 here, 100 here. So they are asking for 1 year. So answer is 700. Answer is 700. Answer is 700. Okay, now one very good question for you. My favorite question, the tax adjustment, the super hit tax adjustment of final account. The super hit tax adjustment of final account. The super hit tax adjustment of final account. Come on, do it. Question number 19 for you. Question number 19 for you guys, please. Question number 19. Make the total tax packet. Make the total tax packets. Come on. Total tax packet. Total tax. Okay. Yes. One answer is just come. Listen. Now make the total tax packet. Total tax. Okay. The balance on the current tax in the trial balance is 2.2 million credit. See, this is over provision. Credit balance means over provision, which is income. Wait, let me write less over provision, that is 2200. Now wait. This is total tax packet. First of all, we'll write current tax provision or current tax estimation. Now this MCQ is not that much difficult. Okay, be very active now. A provision for income tax. Yes, current tax estimation or current tax provision is 14.8 million. 14,000. Current tax estimation is 14,800. Now, the last thing is deferred tax. Last thing is deferred tax. Now, let me check the opening deferred tax liability. Opening deferred tax is how much? Yes. The company's deferred tax credit balance in the trial balance. Okay, credit balance 2,400. Opening deferred tax is a liability. Opening deferred tax is a liability because they are saying it's on credit side. It's on credit side. I hope you remember. Now, and now this is a non-routine thing they have given you. And the carrying amount of its net assets at the end of the current year was 5 million less than their tax written down value. That means at the year end, the tax written down value is higher, tax base is higher, and carrying value is lower. Tax base is higher and carrying value is lower. So it's a deductible TD. Now, this 5,000 is a deductible TD. Wait. Normally, in case of assets or net assets, when carrying value is higher and tax base is lower, carrying value is higher and tax base is lower, then you get a taxable TD. And in your majority past papers, you get taxable TD. But now, in this question, it's a deductible TD because the tax base is higher and carrying value is lower. Read the English, read the statement. So you have a 5,000 deductible TD, and when you multiply it by tax rate, you will get 1,000 DTA. At the year end, now you have a 1,000 deferred tax asset, not liability. So now, if this would be a liability, it would come on this side. But as this is an asset, so it will come here. As this is an asset, so it will come here. So now 2,400 plus 1,000 will give you how much? 3,400 is your income. 3,400 is your deferred tax income. 3,400 is your deferred tax income. 3,400 is your deferred tax income. This is a new non-routine thing. This is a little bit non-routine dodgy question. Little, not much. So now this will be deducted from this packet. Deferred tax income is deducted from this packet. Less deferred tax credits. $9,200. Okay. Some students have done it also. Some students have done it also. Now, if you say you can't do this, I will go inside this screen. If you can't do this question, 20 is, you have 30 seconds. Come on, 30 seconds to solve this question. You have 30 seconds to solve this question. Do it. It's 1st January 14. then it's the first year and then the second year. This is December 14 and this is December 15. Okay, what is the answer? Tell me. You know, as see, they are giving you dodge and you are picking that dodge. This is the game. You know, have you ever given aptitude test MCQs? See, this is the MCQ like, yes, B is the correct answer, not A. B is the correct answer. B, 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 B. B for ball, B for butter. Listen, your initial grant was 10,000. Your initial grant was 10,000. And you know, the grant was spread on the life according to that asset, So this is a depreciating asset, and this depreciating asset will go in the P&L over 10 years. So grant will be amortized over 10 years. So 10,000 was the initial liability. Listen, 10,000 divided by 10, it's 1,000 per year. So in the first year we'll amortize 1,000. Now when we amortize 1,000 in the first year, so how much total liability left at the year end? Total liability is 9,000 total. Next year there will be more amortization of 1,000. So 9 minus 1, how much will be left? 8. Now as you are staying right now, you are staying here 31st December 14. I agree, you have a total liability of 9,000. And out of this 9, how much will be left after 1 year? 8. So this 1,000 is your current and 8,000 is the non-current. So automatically, see, 1 plus 8 is 9. Your total liability is 9, but the breakup is 8 plus 1. Please don't do this silly mistakes. Don't do this silly mistake. Otherwise, get ready for retake. Start minting some funds. Start earning some funds for the retake then. This was easy MCQ. This was not difficult. To be very honest, if you think this is difficult, then start taking tension. This was easy. Yes, sometime when you are careless or you think you take things for granted, you do mistake. See, this is a lesson. To be very honest, this question was easy. No intention of demotivating you, but honest thing is honest. Now again, free marks. Come on. Open your bags. Come on, pick up the marks. Again, you get the sale. It's sale. Giving you 31 minutes. Okay, I'm not saying anything. 1 minute. You pick your answers. It's a sale. Come on. It's everything on 50% now. These are not one MCQ, it's 4 MCQs. There are total four. Okay, let me start. Listen. With regard to a company's statement of cash flow, indicate which option is correct to complete. Proceeds from right issue. Right issue means you have issued shares. So issuing shares is a source of finance. Issuing shares or issuing loan note is a source of finance. This was easy. Yes. Cash equivalents. Yes. I teach this definition in F3, very detailed, in F7 as well. Even sometime I teach this definition in SBR sometime. Cash equivalents are short-term, highly liquid investments that are readily convertible. Readily convertible means 3 months. Readily convertible means 3 months. And which the second dialogue is which does not carry a significant risk, means which carries insignificant risk. 2 words. You can say which does not carry a significant risk or which carries an insignificant risk. It doesn't mean no risk. There is some risk. There is some risk. Okay. Now, interest paid may be classified. Now, this is very interesting area. On interest paid, there are some clashes in the world. There are some clashes between people. Normally, when I teach and when you see the book, 99% time they book in operating activities. Interest paid, they book in operating activities. But you know, dividends paid are booked in financing. Dividends paid are booked in financing. And dividends is the return of equity finance. Dividend is the return of equity finance. So there are some people who says, when you book dividends in financing activities, why don't you book interest in financing activities? Because interest is also a return of source of finance. Interest is also a return of source of finance. So that's why some people book interest paid in financing activities as well. So this is the answer. This is the answer, operating and financing. But investing never. Investing never. Interest paid cannot be booked in investing. That's not possible. That's not possible. Don't even dream it. Now this is easy. Calculating cash flows from operating using indirect method. And increase in inventory is decrease in cash. You subtract it. Decrease in payable is decrease in cash. You deduct it. Yes, a decrease in receivable is added back. Decrease in receivables is increase in cash. There is an inverse relationship between receivable and cash. Remember? So this is the answer. How was the difficulty level? Come on, tell me. What's the difficulty level? Good, tough or easy? Tough or easy? Okay, okay. It's a sale. It's a sale. Question number 22. Again, some sort of sale. Yes, it's some sort of sale. Statement of changes in equity, so she. Now be careful. Hope you remember Soshi. In Soshi, you have retained earning. In Soshi, you have revaluation column. In Soshi, you have ordinary share capital. Remember the column Soshi. Excellent, excellent. Very good, very good. Yes, profit after tax goes in retained earning. We clearly showed profit after tax. But amortize, no. Amortization is pure expense that goes in income statement. And yes, revaluation, you write revaluation in the revaluation column. Yes, yes, yes. Through revaluation, through OCI goes here. Through OCI it goes here, and it's obviously you need to report here. So yes, 1 and 3. 1 and 3. It's 1 and 3. Yes. Good. I would say this question is again easy, but yes, you must have a good memory. If you have a good memory, you can do it. You start it and let me make the format. This is for sure thing that this thing we all teachers teach in class. This is about associate, carrying value of investment in associate. You start and let me start as well. Okay. So now A has 0.8 million. 0.8 million means $800,000. 800,000 and it's dollars. 0.8 million means $800,000. It's not number of shares, it's dollars. Of equity share capital. See, share capital and the face value is 50 cents. Face value is 50 cents means 0.5. $0.5. $0.5 per share. Now basics. Wait. Whenever share capital is given and face value is given, whenever share capital is given and face value, how you calculate number of shares? How you calculate? Tell me number of shares. You divide share capital divided by face value. Share capital divided by face value. So number of shares are 800,000 divided by 0.5. This makes 1.6 million shares. These are the actual number of shares. So that means associate company has already issued 16 lakh shares, 1.6 million shares, 1.6 million shares. Don't forget this number. Only this was technical, nothing else was technical. Now on 30th September 13, they do remember this date. P company acquired 400,000 of A shares. Wait, out of 16 lakh, how many shares we acquired? Out of 16 lakh shares, we acquired just 4 lakh shares. We acquired just 400,000 shares. So 400,000 is how much percent? 400,000 is how much percent? Tell me. 400,000 is 25% of 16 lakh. You can do it like this: 400 divided by 1600 multiply by 100. So the holding percentage in this question is 25%. Don't forget, the holding percentage is 25%. Okay. Now, how much we are paying per share? $12 per share. P company is paying $12 per share. So can anybody calculate COI? Yes. This is 400,000 multiplied by 12. 400,000 multiplied by 12 will give you 4,800. I'm skipping 3 zeros. Okay. This is basically 4,800,000. This is basically 4,800,000, but I'm skipping 3 zeros. 4,400,000 multiplied by $12. It's 4,800,000, but I'm skipping 3 zeros. Okay. Now you tell me, you acquired it in 30th September. 30th September means the next day is 1st October. The next day is 1st October. So October, November, December, Jan, Feb, and March. October, November, December, Jan, Feb, and March. See your year end. Your year end is 31st March. All of you, please. So 6 months. So you need to take 6 months profit. What is the profit for the whole year? What is the profit for the whole year is 1,800. Whole year profit is 1,800 into 6 upon 12. See, 1,800 is for the whole year profit. Into 6 upon 12 is 600. Multiply by your holding percentage is 25%. So 900 times 25 is 225. Okay. So COI, add post profit, add share of post profit. COI, add post profit share. COI, add post profit share. That is 25%. Correct. Now, then you get some dividends. See, and it paid. Associate paid a total dividend of 300. Associate paid a total dividend of 300. Now use your brain. When associate is paying total dividend of 300, when associate is paying total dividend of 300 and you are just 25% shareholder, when associate is paying total dividend of 300 and we are just 25% shareholder, so how much dividend we have received? We have received 300 times 25%, that is 75. And hope you remember the rules. Hope you remember the rules that dividends from associate are deducted from carrying value of investment in associate. Are deducted from carrying value of investment in associate. And I have, in my routine lectures, I have taught this thing in very detail. I have taught this thing with logic. I teach this area with great logic. Okay. Now you tell me how much is the answer. So your final answer is 4950. This is your carrying value of investment in associate. This is your carrying value of investment in associate. If you just know the rules, If you know the method, this question was again not abnormal. It was a normal question. Although I won't use the word sale, but it's a normal question. Okay, now easy, yes, easy, but question. Now do this question. This is again IS 21. This is again IS. Question number 24 is IS 21. Monetary, non-monetary, but it's all about only monetary. It's all about monetary. Giving you 2 minutes. Giving you 2 minutes, 2 minutes, 2 minutes. Please come on, do it. Do it. I would be happy if you do it correct. I would be happy if you do it correct. And yes, you can do it. Okay, let's do it. Some students have done it. On 12th of November 2005, Oatley acquired goods for resale from a foreign supplier at a cost of ZR 33,800. At Oatley's 31st December year end, the supplier had not paid. Okay, so this is unpaid at the year end. It's a monetary liability. It's a monetary liability and it's unpaid. So first of all, wait. At this date, check the value of liability. 2.2 ZR is equal to $1. 2.2 ZR is equal to $1. Okay. So you are going to shift from bigger number to smaller number, bigger to smaller. So do expect a smaller number now. Do expect a smaller number after conversion. So this 338,800 you will divide by 2.2. Tell me what is the value of your liability. What is the value? 154,000. Thank you. Initially, your liability is $154,000. Initially, you were expecting this much dollars. Okay. But now you tell me at the year end, you didn't pay. So it's still it's your liability. But as you know the rules, for monetary items, you need to retranslate at the year end using year end rate, not average rate. Using year end rates, not average rate. So year end rate is $1, 2:1. So 338,800 divided by 2. What is the value of year end? So yes, 169,400. Now you use your brain. See, your liability has suddenly increased. Your liability has suddenly increased. So when your liability is going up, it's a bad news. When your liability is going up, it's a bad news. It's a bad news. So yes, you have exchange loss. How much? take the difference. 15,400 is your loss. 15,400 is your exchange loss. 15,400 is your exchange loss. Yes, recorded in P&L. Yes, 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 yes. Because monetary item exchange gain or loss goes in P&L. Yes, good, 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 good. Now, question number 25, again, little bit dodgy and related to book reading, purely book reading. See, in this way, you get advantage of book reading. Come on, do it. Come on, do it. You have okay. Now listen. But I hope you have studied the lecture. These are just revision days. Okay, so I'll give you some hints. The currency of the country in which entity operates. Listen, listen. This is not the answer. First of all, there is a possibility, like I have a company in Pakistan. You know, the currency of Pakistan is rupees, PKR. The currency of Pakistan is PKR. I have a country in Pakistan in Karachi. Let us say Karachi is my city, and the functional currency is dollar or euro. There is a possibility. I have a company registered in Karachi, Pakistan, but the functional currency may be dollar or pounds or euros. How? For example, my major sales is in dollars. My employees are also in foreign countries. They are also in dollars. So if the major factors are in dollars, so no issue. If I'm still in Pakistan, the currency, functional currency is dollars. And there are many entities in Pakistan like that. Okay. So this is not the answer. The currency in which sales prices are set, this is a factor. Yes. This is a factor. Yes. Yes, this is a factor. When you decide about functional currency, this is one of the factor that your sales is in which currency. Your sales, which currency decides your sales selling price. This is one of the factor, not the definition. The currency in which fund, this is the definition of presentation currency. This is the definition of presentation currency, not functional currency. Now wait. The currency of the primary economic environment in which the entity operates. Yes, this is the official definition. The currency of the primary economic environment in which the entity operates, entity operates. Yes, yes. Right. So listen, I'm just registered in Pakistan, but my major operations in US. So my sales, my cost, everything is in dollars. So see point number D. I'm operating in US. So obviously my functional currency will be US dollars. Right. So answer is D. So signing off now and wish you best of luck for your exams. Now don't waste a single day. Make a proper study plan. Penalize yourself. Give yourself a target for every day. And check the variance as well. Okay, still you can clear the paper. Still you know a lot. I have seen this. I have seen those who are attending this live class. They know a lot of things. You guys just need the confidence. Just think that 50 marks is nothing. If you do 50% mistake, still you will clear. This is the phenomenon. But normally You can see students get 65, they get 70s, they get 80s, even they score 90s sometimes. So not a difficult game, just you need confidence. And one more thing I forgot to tell you, stay away from negative people. This is the very important formula to clear the exam. Stay away from negative people. They just transfer their own guilt in you, because they couldn't study, they waste their time, and then they find partners. They find partners to share their guilt. Okay, so be careful and best of luck. Allah Hafiz. Thank you.